what are payday loans? And we had this question a little bit earlier, and I'm here to answer it. So they're basically fast cash now. You need cash in between the time that you get, or you need cash now, you get paid in a couple of weeks. They're short-term loans meant to be about 14 days long, and most of the time, the way that they're marketed is that they're used for emergencies. Just a couple of fast facts about payday loans is that it's one of the fastest growing consumer loan industries, and most people like to go to payday lenders because it's more convenient and often it's less intimidating than going to get another credit source. There are 19 million U.S. households that have got payday loans, and the payday loans that they have got are worth more than $35 billion, to kind of give you a scope of what this industry is like. So how are payday loans used? In a survey, this is what some people have reported using their payday loans for. But the number one reason why people get payday loans is for regular recurring expenses, like their phone bill or to make rent. So because this is how most people use their payday loans, I want to give you some information on the Colorado's rules so that you're an informed consumer if you choose to go this route. So first, there's a couple of fees that are associated with these loans. There's a finance charge, and in Colorado it's a two-tiered system, which makes it even more complicated and hard to understand. If you get $300, the fee cannot exceed 20%. If you go above $300, then they can charge you a 7.5% fee on any amount above $300. If your loan lasts long, yes, sir.
You're saying 20%. Is that 20% for 4 days, or is that 20%? What's the APR?
So I will get to APR next. That's an excellent question. This is actually different than the annual percentage rate. This finance charge is what you're going to be charged just on the day to take out the loan. This is the fee to actually get the money, the cash in hand. Okay? We'll talk about finance charges right next. But first I want to mention a monthly maintenance fee. That if you have your loan longer than 30 days, every 30-day period, they can start charging you $7.50 per $100 loan and a maximum of $30 per month. So, as you mentioned, there are some APR restrictions and there's some rules to kind of prevent these businesses from really taking advantage of consumers. But there still need to be caution on this area. So an annual percentage rate is what you were talking about, and that's different than the monthly maintenance fee and the finance charge, because an annual percentage rate is it's a fee that is charged if you have the loan for the whole year. So it's based on an annual time frame instead of like one-time charge or a monthly charge. And for payday loans, their maximum amount is 45%. The max amount of loan that you can get on a payday loan is $500. Something to know about this is that you can get more than one payday loan. So there's no limit on how many payday loans you can get, but each payday loan is limited to $500. And that $500 includes the fees. You have about 6 months to pay it off. So if any lender asks you to pay off or requires you to pay off a payday loan before that time, they're not allowed to do that. In Colorado, all the lenders are licensed, and if you pay off your loan prior to the loan term, 6 months, then they have to refund you a portion of the annual percentage rate that you have already paid. And if you change your mind, you have a right to cancel the payday loan by 5 p.m. the next business day. So I want to kind of talk about how it works and use an example. This is Lucille. Lucille is a teacher at Boulder Valley School District. She makes about $2,500 a month, and she's had her job for 4 years. She's about the average person who gets a payday loan. She went out and she bought an iPhone and then realized that she was out of cash between the time that and now she needs to pay a bill, and so she turned to a payday lender. She goes in on March 25th to borrow $400. She gets paid on April 1st. she's gonna get up to a $60 fee. That's 20% for the first $300, but it doesn't stop there because she's getting $400 in cash. So they're gonna charge her $7.50 for that extra $100. So on the day that she gets this payday loan, she's gonna be charged $467.50 to receive $400 in cash that day. But it doesn't stop there. This is how the fees kind of add up. This is how it all works together. So if Lucille can pay her payday loan by April 1st, she's gonna have to pay some annual APR on it. And her APR for this specific loan is 40%, but like I said, they can't exceed 45%. So if she pays it by April 1st, $470.60. By May 1st, it's 30 days out, so now she's getting charged a maintenance fee. So it's $515.86 if she pays by May 1st. And if she goes another month, she gets charged a second maintenance fee. So her total on June 1st would be $561.16. So you can see how these fees add up quickly. And this was so that she could have $400 cash when she needed it.
So basically it's $20 for every 100?
It really depends on the payday lender that you go to. The fees are different, and they have to disclose to you what your annual percentage rate is, and we're going to kind of go into that right now. So there's some dangers for consumers when they're getting these types of loans to always keep in mind. The loan terms can be very confusing. So a couple other of my colleagues have talked about it. These are big contracts, and they vary all the specifics in these deed contracts that people don't understand. And a lot of payday lenders leave the loan center not knowing what their annual percentage rate is or how these fees add up. Most payday loans are interest only. So if you end up needing to go over the 30-day mark, you're extending your loan period longer, the fee that you're paying to keep that loan extended only is paying the interest. It never pays down the principal. This is how you hear stories sometimes of people paying $1,800 for a $300 loan. They're never actually paying down the principal. They're only paying the fees to keep the loan going. Not all loans are interest only, but you should know the difference that some are. It's difficult for consumers to determine the full cost of the loan. As we just talked about in my example with Lucille, the fees really add up quickly, and so people tend to underestimate the time that it'll take to pay off these types of loans. So it becomes very difficult to fully comprehend how much money you'll be paying in the end to get that cash at the time you need it. Another key thing to keep in mind is that these loans aren't dependent upon your ability to repay. Any person who gets a payday loan, they don't have to have good credit, which makes it a good reason why a lot of people like to choose these types of loans. But like I said, the fees can add up and it can become difficult to repay. Another thing is because a lot of people use these loans for regular recurring expenses, what happens is that then they start just paying the finance charge to keep the loan alive, because when it comes time to repay the loan, they don't have the money to repay the loan. So they pay the fee to keep it going alive. Well, they're doing that every month. So instead of actually paying or for the loan to actually help with the monthly recurring expense, they've basically added a new monthly recurring expense by taking out this loan and keeping it alive. This is what's called the rollover or a debt cycle, and that's when your loan becomes due and you're not able to pay. So you take out another payday loan to pay off your current existing loan, or you just pay the monthly fees to keep the loan alive. And a couple of statistics on this is that this is essentially how the business is run. They depend on people rolling over their loans and this debt cycle. Borrowers who immediately take out new loans during the next pay period account for 3/4 of all payday loan volume, totaling more than $20 billion. And the fees that they pay on these loans are $3.5 billion. So this is where the companies are making their money, is by people rolling over their loans. There's a new trend right now, and it's internet lending, and some of my colleagues have already talked about dangers of the internet. What's tricky about payday loans is that they can charge less than the storefronts because their overhead is less. So the fee, it looks better to a consumer because the fees are cheaper. But they're basically faceless lenders. You don't know who's servicing your loan. It's hard to find out if it's a bank or a reputable person, and oftentimes customers will give a lot of personal data online before they ever hear any of the loan terms. Here's some alternatives that I could just think of instead of getting a payday loan. Like I said, they're mostly for recurring bills. You can ask your friends and family. You can try and get a front on your paycheck from your current employer, maybe checking out with HR department, see if that's possible. Banks also offer similar type service, usually at cheaper rates. It's not as expensive. And budgeting and working with people to create some type of savings. These companies prey on people who have no savings, and so having just a little bit of a cushion for those times that you find you need a little bit of extra cash really can help. I've included a slide with some services. All these services, including here at Boulder County, they'll help you with rent assistance, food assistance. You can get help with paying your electric bill. So these are really great resources all here in Colorado, and I also strongly encourage you to work here with the people at Boulder County because they can help you with all this stuff too. And so these are all great resources as an alternative instead of taking out a payday loan if you find yourself in cash. Sometimes you just need the cash and you don't need food assistance or rent assistance. And so that's why I kind of want to educate you guys on how these types of loans work and things to keep in mind if you choose to take one out.
Some of these payday places, check cashing places rather, that do payday loans, in California, they ask you to sign a check, a pre-date check. Do any of these do that?
So this is exactly how it works. Yeah, I failed to mention that earlier. So what happens is you go into a payday loan center, and the way you get the cash is you have to authorize the lender either through electronic bank transfer that they can automatically take out the funds from your bank account, or you write a check and it's post dated until the date that you get paid. So that's like what the contract kind of between the consumer and the lender looks like. Here at the Attorney General's office, you can file a complaint because it is a regulated industry within Colorado, and that would be her way to see if she has some remedies there. Is there any other questions that I can answer today?
But really, it's like the absolute worst way to get money. I mean, nobody anywhere charges that kind of interest fee on anything else, right?
So when you add all the fees together, these loans tend to have triple-digit interest rates. Most are above 300%. I think the average in Colorado was 191%, which is lower than a lot of other places. But that's when you add all the fees together and the short amount of time that these loans are outstanding.
This is why